So once again, good afternoon. We'll be continuing with this this week. Recall that last week we started with IAS 1, and IAS 1 talks about presentation of financial statements. What is our objective? Our objective is to ensure that at the end of the day, we have a full understanding of what the component of a financial statement is. How do we prepare the financial statements? What actually are the elements, the components of every financial statement? And more importantly, when you are adopting IAS or Ifrs for the very first time, what are the requirements and the things you need to know before we will now look at how do we do estimates of our tax provisioning? How do you compute or estimate current tax? What are the components of the current tax? How do we estimate or compute deferred tax? And what are the various components of deferred tax? Why do we have to compute all of these taxes? So all these are part of the plan as a learning objective that we have set out for this month. So I want to believe that everyone still have a good knowledge of what we did last week. Because of time, we might not have sufficient time to go into all of that. But with that very assumption, we start with IFRS 1. In this topic, most definitely, we are looking at or considering businesses or companies that have been in businesses for a while, possibly preparing their financial statements using other standard other than IAS or IFRS. As you know, in Nigeria, prior to 2012, the standard that we use then is called the SAS, Statement of Accounting Standard. It is not out of place if you call it the NGAAP, Nigerian GAAP. But with effect from 2012, transitioning period to 2015, we adopted IFRS. The IFRS that we adopted was before now called IAS. That transitioning of the name from IAS to IFRS occurred also around 2001. So if you notice most of the standard we're talking about, you will observe that the changes from IAS to IFRS occurred sometimes around 2001. It's either the new body, IASB, who took over from IASC, fully adopted the existing standard or make some relevant changes to it. Is that clear? So what IFRS 1 is all about is we are looking at entities, whether they are just starting business or they've been in business for a while, but they have never at any point in time prepared any financial statement in line with IFRS. So in the course of this section, we'll be looking at the introduction to the standard. How does the standard come to play? What were the existing provisions when you are adopting IAS for the very first time before the advent of IFRS? We look at the objective of the standard. Why do we think the standard is actually introduced? What does the standard seek to attain? Definitely, we also consider what are the scope of the standard. What area were covered by the standard and which were not covered by the standard. The recognition and measurement. At what point do you have the obligation to report or present your financials or its components in line with what IFRS 1 has provided? And how do you measure the various components or elements of the account? What do we mean when we say you are preparing your opening IFRS statement of financial position? What does it mean? How do we make our accounting policies in line with this? What are the exceptions to retrospective application of other IFRS? And what are the exemptions from other IFRS? What sort of presentations and disclosures are we to make? And what do we mean when the standard says your account must have comparative information? Then we look briefly at the explanation of transition to IFRS and the effective date. Towards the end of this section, we pick a typical example of a client, practical scenario. You see how it looks like when you're actually doing this in practice, right? But for confidentiality purpose, when we get there, I will stop the video recording. Do you understand? Because it's a live practical scenario of a client's issues. And because we'll be posting this video, we'll be sharing with everybody, we don't want to have that exposure, right? So, in April 2001, remember I said the major transitioning between IASC to IASB occurred sometimes in 2000, 2001. You see that at that point when you are taking up any standard, IASB will either be telling you that, oh, we have changed the existing standard entirely, or we have adopted the existing IAS. Is that clear? So in April 2001, the International Accounting Standard Board, IASB, adopted SIC 8. What does SIC 8 mean? First time application of IAS. That SIC 8 was in place then when the international standard was entirely known as IAS, right? What then also happened when you are also taking or adopting the IAS for the first time? That was what SIC 8 talks about. So when you adopted SIC 8, first time application of IAS, as the primary basis of accounting, which had been issued by the Standing Interpretation Committee, that is the SIC, of the IASC in July 1998. So this was a synonymous version of what we now call IFRS. So it is this IFRS 1 that took over and make requisite or relevant amendments to the SIC 8. Is that clear? Just like when we talk about IFRS 16. IFRS 16 stemmed out of what? IFRS 16 stemmed out of what? IAS 17. That was the then lease that we have. Good. So this was replaced in June 2003, when the board issued IFRS 1 for the very first time, right? So the first time that this introduction came to play was in 2003. But prior to 2003, we had SIC 8, which was the first time application of IAS that was adopted from IASC by IASB. Is that clear? Now, it is important for us to stress that all the terminologies used in IAS 1 were still adopted in IFRS 1, right? So what are some of those terminologies when we talk about what an asset is, what a liability is, what an income or equity is? What are the statements to be prepared? Statements of financial position, statements of comprehensive income, or statements of profit or loss and other comprehensive income, statements of changes in equity, statements of cash flow, note to the account, and every other component that we use there. So you will still be seeing replicas of these in IFRS 1. There were other amendments to IFRS 1 in 2004. There were 2008 and that of 2010. What happens? In each of these periods, the drafters of the standard looked at the components of the standard and see whether it is sufficient to meet the demands for business reporting as at those period. But the most important of which we have identified in December 2010. In December 2010, the board amended IFRS 1 to reflect that a first-time adopter will restate past transactions from the date of the transition to IFRS standard instead of at January 1, 2004, right? You remember the standard was introduced in 2003, right? As at that period, that singular commitment was not there. So this very amendment was made in 2010, and everyone who is then adopting IFRS for the first time, you have to show how you move from what you used to have to this current one. Don't just say, oh, since I'm starting, I adopted it in 2011, you will jettison what happened before 2011 and just go on from there. No, there has to be that transition, that move in, that the prior position has to be integrated with the current period, while those transitional adjustments has to be accounted for as expected of this, provided in the standard. So that is what you are expected to know as far as the origin of how IFRS 1 come to play. Remember, I will repeat that again. The standard stemmed out of SIC 8, which then was talking about when you are adopting IAS for the very first time, right? And no material change in the outlook of IFRS 1 until 2010, when that transitional adjustment from the prior statement of financial position to the current statement of financial position is expected to be displayed, right? So having known all that, what is the purpose for which the standard setter introduced IFRS 1? Why do you think IFRS 1 was introduced? What is the relevance of you having or not having IFRS 1? At what point will you say you are fully compliant with IFRS 1? Under what circumstance would your non-compliance with IFRS 1 be accepted or welcomed by the standard? Do you understand? So the objective of this IFRS is to ensure that an entity's first IFRS financial statements and its interim financial reports for part of the period covered by those financial statements contains high quality information, right? The major and one of the main purpose of any standard, accounting standard in particular, is to ensure that what you are reporting is not only fair, but also a faithful representation of reality. Do you understand? So IFRS 1 has not deviated from that objective. We want to be sure that what you have disclosed or intending to disclose is of quality and is a true representation or faithful representation of what has actually occurred within the period you are reporting on. And also it should be, there should be dash. It is transparent for users and comparable over all period presented. What are we saying? What do we mean by that? Users of this information, their intended use must have been factored in. Remember, we talked about this in IAS 1, that while you are preparing the financial statement, you must emphasize who are the stakeholders. What purpose do you think they will require this statement? So you must prepare the statement in such a way that without they having a need to come and meet the drafter or the preparer of the financials for their specific need, picking a general purpose financial statement will address all their expectations. Do you understand? So that is the same objective that IFRS 1 is trying to uphold when it says that whatsoever high quality financial information that you are preparing must not only be what? Transparent to the user, but there should be a comparison between the current period and the prior period, except when that period you are just preparing that financial is your first financial account. Is that okay? So second one is that it should provide a suitable starting point for accounting in accordance with IFRS. So we should be able to say, oh, with effects from the date we start to adopt IFRS, this is the starting point. You could have been preparing financial statement for so many years and not have adopted IFRS. So whenever you choose to adopt IFRS, you should be stated clearly that this is the first time you are adopting the IFRS, and that will be taken as the starting point. Then 3 can be generated at a cost that does not exceed its benefits. I think I also explained this before now, when we say if the purpose or the total value of a business is 100 million, and transitioning from what you used to have to this current one will cost 150 million. Is it economical? So cost of compliance with IFRS must be as objective as possible, must be as economical as possible. That was why the standard setters felt that adopting IFRS for all business may not be very economical. Remember, we mentioned something last week that small business may opt for. What was it? You remember? I think it was this class I mentioned it. IFRS for SMEs. I didn't mention it last week. Yes. Yes, that I said that, what do I call it? FRCN observed that, oh, when auditors and management are preparing financials, they just adopt IFRS. Meanwhile, the disclosure requirement for IFRS is so enormous that if SMEs has to comply with it, it won't be very convenient. It will be so expensive. Look at the complexity that comes with IFRS 9. And implementing IFRS 9 could even be so expensive that companies would then not want to adopt that or comply entirely with it. So this standard is saying that even though you have the intention to comply with IFRS, you must also measure the benefit that comes with it. Where the benefits or the cost outweighs the benefits, then it is not reasonable complying with IFRS. And this is one of the issues that US had with IFRS while they have not adopted IFRS till date. Is that clear? So still under the scope of IFRS, we've outlined how we come about IFRS. We've talked about what are the objectives, what are the things that IFRS seek to achieve. Do you understand? As you continue with your stewardship responsibility, are these objectives attainable? Is that clear? So next to it, we have to talk about what are the range of coverage of the standard. What are the things that are within the purview or expectation of IFRS 1, and what are the things not covered by IFRS 1? An entity's first IFRS financial statements are the first annual financial statements in which the entity adopts IFRS by an explicit and unreserved statement in those financial statements of compliance with IFRS. What do we mean by that? If you have been preparing financial statements all the while in line with IFRS, and you did not explicitly state there that the basis or the standard with which these financials has been prepared is an explicit and unreserved statement of compliance with IFRS, you may not have been deemed to have complied with IFRS. Do you understand? So you must not only comply with IFRS in principle, you must also affirm or attest to it that, oh, you have complied with IFRS. The standard expects you not just to comply with the path and do away from others, but you must comply with all relevant and applicable standards relating to that reporting entity, right? If for any reason you could not comply with other parts, you need to justify essence of your non-compliance with that part. So financial statements in accordance with IFRS are an entity's first IFRS financial statements if, for example, the entity, look at this, if, for example, the entity presented its most recent previous financial statements in accordance with the national requirements that are not consistent with IFRS in all respects. You could have complied with IFRS by not also following IFRS. That is what that is talking about. Because the standard is not above the local requirements. Do you get what I'm trying to say? When there is a conflict between the statutory provisions in the local, in the country, and it is in conflict with what IFRS is saying, IFRS allows you, if compliance with that local standard or local provision will give you a much more true and faithful representation, right? Then following the national requirements is also deemed that you have also followed what? IFRS. Is that clear? The second is that the financial statement must be in conformity with IFRS in all respects, except that the financial statement did not contain an explicit and unreserved statement that they comply with IFRS. So the standard is trying to also be not too rigid, right? If in context you have prepared all the components of the financials in line with what IFRS expects of you, but you did not state explicitly, provided at least the previous financial with the current one are in compliance with every requirement of IFRS, you are deemed to have also complied. Is that clear? Not that last year I'm in compliance with IFRS, this year I am not. Next year I will be, and all of that. That inconsistency must not be there. So I could have been preparing my financials in line with IFRS, but not having stated it. If that consistency can be verified, you will be, you could be technically assumed to have complied with IFRS, though you have not publicly stated that you are complying with IFRS. Containing an explicit statement of compliance with some, but not all IFRS. So I've said it that where you cannot, you can justify that compliance with some and not with others will give you a much more fair and faithful representation, even though you have not technically or absolutely obeyed all the statutory provision, the standard provisions in the IFRS, you can still be deemed to have followed the IFRS. Then, whatsoever you have prepared must also be in accordance with the national requirements inconsistent with IFRS, using some individual IFRS to account for items for which national requirement did not exist. Now, that may look a little bit confusing, right? You are following the national requirements that could give you fair and faithful representation. Is that clear? Which is in conflict with IFRS. But IFRS says where your local requirement is in conflict with my own, obey your local requirements. It is not superior to local requirements. But in the course of you obeying the local requirement, there are some things that the local requirement did not say anything about. Should you now leave it vague? No. You then have to look at the existing IFRS that actually talks about those and then adopt it. Is that clear? So in doing so, you will then be seen to have complied with IFRS. So coming back to this, remember, we said it earlier that among the scope of requirements with IFRS, entities are expected to present its most recent previous or previous financial statement in accordance with the local requirements if it is not inconsistent with what? The IFRS. The previous financial statement must also be in conformity with all IFRS in all respects, except that the financial statement did not contain an explicit confirmation. Do you understand? The third one is there must be contained in it an explicit statement of compliance with some, but not all, the IFRS. Then the last one under that segment, second to the last one under that segment is whatsoever you are prepared must be in accordance with the national requirements inconsistent with IFRS, using some individual IFRS to account for items for which national requirements do not exist, right? Then the last one, it must be in accordance with national requirements with a reconciliation of some amount to the amount determined in accordance with IFRS, right? So when the national requirement says assets should be reported as 50,000, and the standard is saying assets should be reported at 40,000, right? Now, there must be a reconciliation of what the standard recognized to be capitalized, what the national requirement requires to be capitalized, which the standard did not recommend or provide that it should be capitalized. That reconciliation must be there. Do you understand? Not just say, I'm reporting 50,000 and jettisoning the 40,000. You should be able to say, I've reported 50,000. However, the 10,000, which is the difference between them, the standard provides that this should be what? Expense. Meanwhile, my local requirement is saying capitalized. So that reconciliation must be clear. Then the second one is whatsoever financial statement that you have prepared, you should prepare the financial statement in accordance with IFRS for internal use only, without making them available to the entity's owners or any other external user. So I can choose to prepare my internal use or internal purpose financial statements to be in accordance with IFRS. That is what that is saying. The third one, prepare a reporting package. Prepare a reporting package in accordance with IFRS for consolidation purpose, without preparing a complete set of financial statements as defined in IAS1 presentation of financial statements. What are we saying? You know, when you are consolidating your financial statements, there are a lot of adjustments you have to make. You are not preparing a complete set of financial statements, but all of those adjustments, which will then be consolidated, has been adjusted in line with the applicable IFRS. So the underlying figures that you are using to preparing the main financials is in compliance with IFRS. If you have done that, then it is seen as having complied with IFRS. Then 4, did not present financial statement for previous period. So you will say you are adopting IFRS for the first time if that was not how you did in the prior period. Do you understand? If you have done all of these in the prior period, then you are not adopting IFRS for the first time. Is that clear? So still under the scope, this IFRS applies when an entity first adopts IFRS. It does not apply when, for example, what are the periods? We've talked about when you are deemed to have complied with IFRS. What are those periods that, even though you are complying with IFRS, but that was not your first time, right? If, for example, when an entity stopped presenting financial statement in accordance with the national requirement, having previously presented them as well as another set of financial statements that contain an explicit and unreserved statement of compliance with IFRS. Now, in this instance, you have been complying for some time. For reason best known to you, you stop to comply. And after maybe 1 or 2 years, you decided to go back to compliance. You will not say that is the first time you are complying with IFRS. Do you understand? The standard is not saying that there couldn't be reasons for you to stop complying. Maybe it's not economical for you to have complied during those period of gap. But what the standard is saying is that don't misdirect us by saying this is then, the subsequent period is then the first time you are applying the IFRS. Is that clear? Madam, you're looking as though you're lost. Do you understand it? What we are saying another way is this. I've always been to Lagos, right? And I'll stay off Lagos for about 2-3 years, right? Now, coming back to Lagos after the period of the stay off, I should not tell anybody that that is the first time I'm coming to Lagos. Even though I could get to Lagos and see a lot of things has changed, right? But I must not say this is my first time in Lagos. Is that clear? Then presented the financial statements in the previous year in accordance with the national requirements, and those financial statements contain an explicit and unreserved statement of compliance with IFRS, or presented financial statements in the previous year that contain an explicit and unreserved statement of compliance with IFRS, even if the auditor qualified their account, they qualified their audit report on those financial statements. So this is still giving us reasons when we cannot say this is the first time. We've done it before. Maybe you just want to start on a fresh note because your previous account was qualified. You know when we say you qualified your account. So because your account was qualified in the previous period, you now want people to see you anew, right? So you can't say that is the first time you are adopting IFRS. So that is in brief what is expected of you as far as the scope of the standard is all about. It's just that scope is just telling you at what point will you be seen to have complied or adopted IFRS for the very first time. You are not saying, the standard is not saying you cannot choose to stop or you can choose to stop, no. But what we just want to be double sure is at what point do you kick off for the very first time? So recognition and measurement. How do you recognize and measure items or elements of the account when you are adopting IFRS for the very first time? The starting point of, for an accounting in accordance with IFRS are, number one, that an entity shall prepare and present an opening statement of financial position. So if you say you are adopting IFRS for the very first time, the very first thing you should then do is to prepare statements of financial position at that date that you are adopting it. Is that clear? So if you say you have adopted IFRS and we could not see your opening statement of financial position, it then means that you have not adopted IFRS, right? Just like I said earlier on, at the end of this session, we will show you some client reports where the client actually adopted IFRS for the very first time. So you could then relate it with all of these stories or expectations of the standard. Then the next one is that an entity shall use the same accounting policy in its opening IFRS statement of financial position and throughout all the period presented in its first IFRS financial statement. Those accounting policies shall comply with each IFRS effective at the end of its first IFRS financial reporting period, except that there is an objective evidence that those estimates will be in error, or were in error. Now, what are we trying to say there? Now, you have adopted IFRS for the very first time, and you have also prepared the opening statement of financial position. You can't prepare the opening statement of financial position if you have not gone through the applicable standard and make an accounting policy. So whether consciously or unconsciously, in preparing that statement of financial position, you have also implied that you have drafted an accounting policy. Is that taken? So what this is now telling you is that in the subsequent period, you should not prepare financial statements using a contrary policy, different from what you have adopted when you adopt it for the very first time. The only reason why you when you are allowed to deviate is if that deviation will give you a better or a fair and faithful representation, right? Anything other than that, you started with one, you must continue with that which you have started with. Then the starting point, oh, okay, I think this one was repeated. Then since IS1 requires that at least 1 year of comparative trial period financial statement must be presented. You know, we will talk about that. The opening statement of financial position will be 1st of January 2013, if not earlier. So we are now relating it to what happens in Nigeria when Nigeria actually adopted IFRS for the very first time. For those who are now to adopt IFRS in the year 2013, do you understand? You know, the standard was introduced sometimes 2011, 2012. The first year of compliance was seen to be 2013, right? So if you are adopting in 2013, at the beginning of the year, when you are adopting it, there must be an opening statement of financial position. This will mean that an entity's first financial statement should include at least 3 statements of financial position. How would that be? Assuming I've been in business for the very first time, and my usual year end, please listen to this. Assuming I've been in business for the very first, I've been in business more than one year, but I'm adopting IFRS for the very first time. Let's say my first year of adoption is 2015, right? It means I must have had comparative information of 2014, Abi? So my year end of 2015, I will prepare all the requirements expected of me according to IS1. Is that not? Including what? Statement of financial position. That is one. IS1 also expects me to have comparative figure. Is that not? So also IFRS 1. So I should have my comparative figure. My comparative statement, information for statement of financial position will be that of what? 31st of December 2014. Is that not? Good. What this standard is now saying is that you should have at least 3 statements of financial position. The first one is 31st of December 2015. The second one is 31st of December 2014. At the beginning of that 2014, which I can call 1st of January 2014 or 31st of December 2013, I must have an opening statement of financial position. So since I know that 2015 is my year of compliance, I will pick my comparative and I will pick the opening of that comparative. Is that clear? But all that will not be there if that is the first time I'm preparing the financial statement in compliance with IFRS, and that is the first year in being in business. Do you understand? If that is the first year of being in business and that is the first year of preparing the financial statement, I will then only have 2. I will have opening on the first day of that year that I'm starting that business, which is the opening, then I will have the year-end information. But if I've been in business in a period longer than that, then I'm expected to having 3 statements of financial position. I hope that is clear. Good. So how do we then do this in practice? It then means that I will pick the comparative year accounts. I will restate the opening. You know that comparative will in itself have its own comparative. I will start from that opening of the comparative. Because I want to make sure that what we are talking about here is as practical as possible. Let's assume 2010 is my first year of adoption. And I have 2011 comparative. But let's say I have 12 and 13 here. Let's say 2012 is my first year. This 2013 is the year I'm adopting. This 2013 is the year I'm adopting. 2013 we have comparative of 2012. This 2012, my starting point will now be information of 2011 is the opening of this with the comparative of this and the actual year. That's the point. Yeah, exactly.
What if the entity are not reporting or doesn't have any?
Then I will now say that the opening period and the closing year, that would just then be 2. Do you understand? Then the next one is that you have 2 statements of profit or loss and other comprehensive income. That is the year I'm adopting and the comparative. So statement of profit or loss or and other comprehensive income will not have opening statements. Is that clear? Then 2 separate statements of profit or loss if presented. Then 2 statements of cash flows, right? 2 statements of cash flow, which will be the year I adopted and the comparative. Then 2 statements of changes in equity, that is the year I adopted, the comparative. Then related notes, including comparative information. So that then tells you that if you don't have all of this, you will not be seen to have what? Comply with what? IFRS. Is that clear? Adjustment required to move from previous GAAP to IFRS. In our case, is NGAAP to IFRS GAAP at the very first time of adoption. Now, what we are saying is that, if I pick the opening statement of financial position, what are the elements of the account I will see there? I will see assets, I will see liabilities, then I will see equities. Now, IFRS 1 don't tell you how to treat the transitional requirements for each and every of the components, right? You will only need to make reference to the applicable or the relevant standard. If you are picking PPE now, what is the applicable standard? IAS 16. Are you with me? If you are picking investment property, what's the applicable standard? If you are picking, what's that one? Non-current asset held for sale, IFRS 5. So that's how you'll be picking each of those standards. So IFRS 1 is not absolutely applied or exclusive of other standards. Do you understand? So it only tells you this is your starting point. These are the things you should do. But to know how to do the things you should do, pick what each of those standards has mentioned. Is that clear? So how do we then do all of this? He said you should do recognition of some previous GAAP assets and liabilities, right? If you have certain assets in the previous accounts prepared in line with SAS, that is the Nigerian GAAP or US GAAP, as the case may be, right? And you are now transiting to what? IFRS. If those assets and liabilities were not recognized in the new IFRS, then it means you have to what? De-recognize them. But how do you do that? The entity should eliminate the previous GAAP assets and liabilities from the opening statement of financial position if they do not qualify for recognition under IFRS. Let's see, for example, IAS 38 does not permit recognition of expenditure of any of the following as an intangible asset, right? You could have been using a previous standard. And when, IAS 38 is about intangible assets, it talks about when you are making a research costs, it said it should be expense. If the order or the PRAO standard that you have been referring to or you've been using says you should capitalize, what then do you have to do? You have to de-recognize it. So you need to know what are the components, what makes up of each and every of the previous components of assets, liabilities, and equities to see whether it complies fully with what the new standard has required or expected of you. If it is the same, then nothing will change. 1 million in the previous standard will also be 1 million in the current standard. But if, let's say, a portion of 200,000 of the previous value does not meet the requirements, recognition requirements in the new standard, then you need to make those adjustments. So going further, research startup, pre-operating and pre-opening cost, training, advertisement, and promotion, moving and relocation. All of these don't meet the capitalization recognition requirements under this standard. So you will not be regarded as having fully complied with IFRS 1 if you don't know the recognition, disclosure, presentation, and measuring requirements of other standards. Is that clear? So if the entity's previous GAAP had recognized these as assets, they are eliminated in the opening statement, opening IFRS statement of financial position. Is that clear? If the entity's previous GAAP had allowed accruals of liabilities for general reserve, restructuring, future operating losses, or major overhauls that do not meet the condition for recognition as a provision under IAS 37. These are eliminated in the opening IFRS statement of financial position, right? So I think this is very clear. What are we trying to say? You know, remember those days, which year did you qualify? 2018. You are part of this new generation accountants. Apologies, you are part of this new generation accountants. In those days, you know what we do? When you get your profits before tax and after tax, the question will always say, or the company may have it as a policy, that it's their policy to regard 10% or 20% or 50% of the profit as a general reserve. Or they might just tell you, oh, it is their policy to reclassify certain portion of the whole profit as capital reserve or something. Do you get what I'm trying to say? Now, those things were allowed in the previous standard, right? But because we are now transiting from that previous standard to this new standard, the question is, what makes up this nomenclature or this classification or these elements of the account? Is it in compliance with what the applicable standard on that very thing? If it is not, remove everything there. Is that clear? You will see how it is done. Then if the entity's previous GAAP had allowed recognition of contingent assets as defined in IAS 37, paragraph 10, these are eliminated in the what? Opening IFRS statements of financial position. Then recognition of some assets and liabilities not recognized under previous GAAP. You know, we've looked at the ones that the previous GAAP had recognized, which is not recognized in our GAAP, right? Now, let's also now look at the ones that our GAAP, this current IFRS recognized, that the previous GAAP did not recognize. Conversely, the entity should recognize all assets and liabilities that are required to be recognized by IFRS, even if they were never recognized under previous GAAP. Let's look at this example. IAS 39 requires recognition of all derivative financial assets and liabilities, including embedded derivatives. These were not recognized under many local GAAPs. The truth of it is that Many local GAAP did not even recognize all these complex financial instruments and financial liabilities. So because nothing has been said about them, most definitely than not, when this transaction occur relating to this, they will most definitely have what? Expense them, right? But this standard is saying, give it the deemed treatment that the then IAS 39, now IFRS 9 has provided. Then IAS 19 requires an employer to recognize a liability when an employee has provided service in exchange for benefits to be paid for in future. These are not just post-benefits employment, pension plans, but also obligations for medical and life insurance, vacations, termination benefits, and deferred compensations. In the case of overfunded defined benefit plan, this will be a planned asset. Now, what are we saying? If it is your policy that anytime our staff worked for us, we pay them 40,000 as salary. We pay them 10,000 as pension. We pay them 5,000 as HMO, medical expenses. And everybody or all of the staff will be entitled to a travel to Obudukatu Ranch. Do you understand? That is your policy, right? IAS 19 is saying that the moment the staff has fulfilled their performance obligation, even though you don't have the money to fulfilling those obligations, you should book it, right? What this standard is now saying is that if the old standard you were using did not expect you to recognize something of such, you have to make sure that because we are transiting from that old standard, you have to ensure that you start to recognize and book all of this. That's what we are saying. Is that clear? IAS 37 requires recognition of previous provisions as liability. Examples could include an entity's obligation for restructuring, warriors contracts, decommissioning, remediation, site restorations, warranties, guarantees, and litigations. All of these are expected to be booked according to the standard. But if the old standard expects otherwise, make sure that you book as expected, right? Deferred tax assets and liabilities will be recognized in conformity with IAS what? IAS 12. IAS 32 has principles of classifying items as financial assets and what? Or what? Thus, mandatorily redeeming preferred shares that may have been classified as equity under previous GAAP will be reclassified as liability in the opening IFRS statement of financial position. What we are trying to say there is this, that there are some previous or old standard we use that recognize that items of balance sheet such as preference shares should be reported as an equity. But this is in conflict with what IAS 32 says. Is that clear? So the standard is now saying you have to report it in line with the expectation. Note, IFRS 1 makes an exemption from the split accounting provision of IAS 32. So what we are trying to So where are we? Any question? Can I go on? Yes or no?
When the standard condition is set, it should be reported as standard.
Okay, so what we are saying is this. Let's look at the features of, no, this is the next slide we should talk about, but this is where she was making. Now let's look at the features of, look at me. Let's consider the features of a preference share. Whether it is an equity or a loan. You bought a preference share. You have a predetermined interest or dividends on it, Abi? And you know that as long as the company makes the profits, you will get it. Is it different from when you took a loan from somebody? Even though you are calling the other one equity, technically it is not an equity, because the features of an equity is that you don't have a predetermined return. Are you with me? So what the standard is then saying is that if another standard that you have been using before now allows you to capitalize or report such preference share as an equity, IAS 32 does not support it. That is what we are saying. It rather regards it as a liability. So reclassify it as such. Is that clear? So if the liability component of a compound financial instrument is no longer outstanding at the date of the opening IFRS statement of financial position, the entity is not required to reclassify out of the retained earning and into other equity, the original equity component of the compound interest. Who can explain this one to us? What is a compound financial instrument in the first place? Okay, that's correct. So they are now saying, we have earlier said that the liability and the equity component should be reported as expected. Yeah. So liability and equity component should be reclassified as expected, right? But they are not saying that if that requirement or that obligation is no longer in view, as at the date you are restating or transitioning from old standard to IFRS, you don't need to bother make the adjustments. Do you understand? You don't need to bother. Just like you have a PPE, which before they will have called current assets, I mean non-current asset, right? If the recognition criteria that, oh, the asset has been fully utilized and it's not there again, you won't say because the old standard still allows them to continue to carry the costs, you will then have to restate it there, right? You have to derecognize it. Some offsetting or netting of assets and liability or of income and expense item had been acceptable under previous GAAP may no longer be acceptable under IFRS. Remember we talked about this last week, offsetting aggregations and the likes. So if the other standard had always allowed that, make sure that you comply fully with the requirements of this standard. All right, under reclassifications, the entity should reclassify previous GAAP opening statements of financial position items into the appropriate IFRS classification. Remember, we have those classifications explained in our last class, the various elements of the account. So if in the old standard, something that looks like current assets have been reclassified, have been classified as non-current assets, you have to make sure that you review it. IAS 10 does not permit classifying dividend declared or proposed after the statement of financial position date as a liability at the statement of financial position date. If such liability was recognized under previous GAAP, it will be reversed in the opening statement of financial position, right? So until when the organization has actually made a commitment to actually declare that dividend, you cannot book it. If it is still an intention, remember in the days of SAS, we used to book it. If it's still your intention, but the moment it becomes, it is still an intention, you must not book it, except where there is actually a publicity and that particular commitment has been sealed. Is that clear? If the entity's previous GAAP had allowed treasury stock, an entity owned stock that it had purchased to be reported as an asset, it will be reclassified as a component of equity under IFRS. What are treasury stocks? There are times that companies sell their shares to their shareholders. There could be an average clause there that, oh, at a certain period, we'll buy the shares back, right? So the standard is talking about that if that other standard, instead of you have issued 400 million shares before, and you've bought back 200, how many should you be having? Okay, so what they are now saying is that if the other standard does not reduce that shareholding to 200, but rather report what they have bought back as an asset, still carrying the value as 400, you will have to make sure that you follow what this current standard says. Do you understand? Item classified as identifiable intangible assets in a business combination accounted for under previous GAAP may be required to be reclassified as goodwill under IFRS 3 because they do not meet the definition of intangible assets under IAS 38. I'm sure this one is self-explanatory. The converse may also be true in some cases. IAS 32 has principle of classifying items as financial assets, financial liability or equity. Thus, mandatorily redeemable preference share that may be redeemed, that may have been classified as equity under previous GAAP will be reclassified as liability in the opening financial statement. I gave an example similar to this before. So as far as this is concerned, that is how you are expected to pick each and every component of the standard, of the financials, and adjust them in line with what the new standard says, right? The next thing we are going to look at is that what are now the disclosure requirements? We've talked about the measurements now. We've talked about the recognition. At what point do you recognize? Then we've also looked at the presentation, how you are to present it. The presentation must definitely be in line with what the new standard, that is the IFRS, actually adopts, or the applicable standard. What are the disclosures requirements? Disclosures in the financial statement of a first-time adopter. IFRS 1 requires disclosure that explain how the transition from previous GAAP to IFRS affected the entity's reporting financial position, financial performance, and cash flow, right? So you should be able to state not just that we have moved from this to this, but what is the impact of this transition on your statement of financial position, statements of financial performance, and your statement of cash flows. So this then includes 1, reconciliation of equity reported under previous GAAP to equity under IFRS. Both at the date of the transition to IFRS and at the end of the last annual period reported under the previous GAAP. So you then need to look at, is there any changes? If there is no changes in the requirements, recognition requirements in the previous standard and the new standard, then the figures will be the same. Do you understand? So you need to provide that reconciliation. I will show you how that is done practically. For an entity adopting IFRS for the first time in its 31st of December 2014 financial statement, the reconciliation will be as at when? 1st of January as what? Two, reconciliation of total comprehensive income for the last annual period reported under the previous GAAP to the what? Total comprehensive income under the IFRS in the same period. So you are reconciling the bank's, what do they call it? Statement of financial position. You are also reconciling the what? Statement of comprehensive income. 3, you need to give an explanation of the material adjustment that were made in adopting IFRS for the first time to the statement of financial position that, the statement of financial position, statement of comprehensive income, and statement of cash flow. The latter is presented under previous GAAP. Then if the entity recognizes or reverses impairment losses, that is a function of whether the old standard allows impairment or just normal provisioning. In preparing its opening IFRS financial statement, a statement of financial position, this must be what? Disclosed. Now, appropriate explanation if the entity has elected to apply any of the specific provisions and measurement exemption permitted under IFRS 1. For instance, if it is fair value as deemed costs. So these are major things that you need to look at as far as IFRS 1 is concerned. The second phase we'll be looking at, which will not be recorded, is how is this done in practice, right? So I want to disconnect now and we'll look at that. But any question before that?